Texas job growth returns with some serious caveats. And Texas is back in the headlines for job growth in 2026. But if you're a borrower, investor, or developer, the real story is what's happening beneath the surface. The Federal Reserve Bank of Dallas projects that Texas will add approximately 280,000 jobs this year, and that's translating to a 1.9% growth rate. And on paper, that looks really strong, especially compared to national trends. But if you're making financing or investment decisions, headline numbers can get you in trouble. So let's look at the real story behind the scenes. And the growth is actually slowing a little bit. Economists expect job growth to land closer to 1.1, not 1.9. And that's a meaningful difference. So here's why. So we have declining immigration, less labor force expansion, but also higher productivity, and fewer workers are needed per unit of output with AI. But also a softening business activity, slower hiring, but also geopolitical uncertainty, and it's delaying capital decisions. And this isn't a contraction, but it's not the same expansion cycle that Texas has enjoyed over the past decade. So let's look at what the data is telling us right now. And recent surveys are showing that manufacturing activity has slowed a little bit, and service sector revenue is flattening, but also business sentiment is weakening. And at the national level, even the job gains reported by the Bureau of Labor Statistics show signs of fragility. March's 178,000 jobs added were partially driven by temporary rebounds and not necessarily sustained growth. So what does that mean in English? Well, the labor market is still growing, but it's slowing and it's losing momentum. So why this matters for mortgage and real estate strategy. And this is where most people can get it wrong. If you hear job growth, you're likely to assume that housing demand will surge and commercial demand will follow and financing will stay easy. That's incomplete thinking. So let's talk about why. One, slower job growth generally means more selective lending. So lenders are forward looking, and when job growth slows, underwriting tightens. Uh, Income stability is a bigger question. It becomes more critical, and reserves matter more than ever. And this is where deals can quietly die, not on rate, but on structure. Two is housing demand doesn't disappear, it segments. And in markets like Houston, Katy, and Fulshire, population is still growing, but affordability pressure is rising, and wage growth just isn't keeping pace everywhere. And that result is that entry level demand remains strong, and move up buyers are just a little more cautious, and investors must underwrite more conservatively. Three is commercial real estate becomes a micro market game. So you can't treat Texas or even Houston as one single market. Instead, industrial still benefits from logistics demand, and retail still follows rooftops, but it also depends on disposable income. And office demand depends heavily on job type in the sector, so blue collar versus white collar. And the key shift here is macro growth matters less than the local fundamentals. So let's talk about the mortgage angle and how structure beats rate. And here's the takeaway for borrowers. In a slowing growth environment, the wrong loan structure will kill your deal. So we need to put some thought there. Even if your credit and income look strong, it's worth having a strategy call. And what lenders are focusing on right now is debt to income and DTI, but also cash reserves. 6 to 12 months is generally preferred. And job stability and industry risk is also a concern, but also exit strategy, especially for investors in commercial property. And this is why high income borrowers can still get declined, not because of their personal credit, but because of the structure of the loan ask. So let's talk about strategic opportunities if you know where to look. And this environment isn't negative, it's transitional. And transitions also create opportunity. So smart borrowers and investors are locking in financing before further tightening. but also targeting submarkets with real population inflows, and structuring deals conservatively, not aggressively, and planning their exits based on slower growth assumptions. The bottom line for the day is that Texas job growth is real, but it is also decelerating. And the difference between 1.9 and 1.1% growth isn't just academic, it does impact, say, lending standards or property performance or investment timing. And the investors and borrowers who win in this cycle aren't chasing headlines. They're underwriting to reality. And that, my friends, is it for the day. Please visit my website, billrapponline.com. You can figure out how to schedule a consultation. I'd love to have a conversation with you about whatever you're facing and how we can improve your world. Have a good day.